Hello and a very warm welcome to CEO Immersives. I'm Devina Lasson. Now, in this series, we bring you in-depth conversations with the creme de la creme of India's C-suite to fetch you industry insights as well as personal anecdotes. On this episode, we have an in-depth conversation with Manisha Girotra, who heads Moelis India, an international investment bank headquartered in New York. She helps us understand what the future of the merger and acquisition situation in India looks like, given the global geopolitical and financial volatility. Take a look.
Hello, Manisha, and thank you very much for taking the time out and speaking to business today. As you and I have been discussing many times in the past, Deal Street is buzzing. So we wanted to get a feel of what exactly are the headwinds now that the global headwinds have come upon us, how Deal Street is looking, what is the M&A activity, sort of roadmap looking like from here on. And, therefore, what should companies do? What are the acquirers sort of considering when they want to look at targets to acquire? So without much ado, I'll just jump straight into it. Give us a broad sort of overview of where you see the M&A play happening right now.
Hi, Sourav and Anand. Thanks for having me. So just in terms of the M&A play, let's just see what was happening in the last few years. Last few years, activity was dominated by private equity and venture capital. Last year, PE and VC put in about $80 billion of capital into India. Half of it, let's say, in startups, the balance half in companies where they actually did control deals. Corporates remained kind of dormant in M&A because they were over-leveraged, banks were not lending to them. And a lot of the corporates were deleveraging. A lot of the business houses that you and I knew actually lost their businesses, the NCLT process. That was another stream of M&A activity for us bankers. But for corporate India, it resulted in an anemic pipeline of M&A. So private equity was basically, if we launched any sell-side process, our protocol was private equity and the large private equities putting in large checks. What's changed from 2022, as you and I have discussed in the past, is that you're now seeing corporate balance sheets of the top 25, 30 corporates having really been cleaned up and become strengthened. And their animal spirits are back and they want to do M&A. So we are seeing corporates, getting more and more aggressive. And I think that theme will continue because what happens as you see global headwinds, which you mentioned, Sourav, that you see some of the global capital pull back into their own domestic markets. You see what's happening to the currency, right? It's because a lot of the money is flowing back into dollar-based savings and opportunities. So this is a time where if domestic corporates are feeling positive about expanding their business in India, it's a good opportunity because you're not competing with that kind of private equity money, which basically not only has a large pool of capital, but also has access to much cheaper capital than an Indian corporate would. It doesn't matter what the rating of the Indian corporate is, the kind of liquidity private equity, let's say a Blackstone or a KKR has access to today, or Apollo, is unprecedented. So I think there's a reset of valuation expectations. The seller mind, the buyers sort of getting his dry powder ready. And you'll see a lot more domestic M&A. Till last year, I would say 60%, over 60% of M&A was dominated by private equity and VC. You'll probably see that tilt in favor of corporates in the same ratio, i.e. corporates will lead the M&A space in the next 12, 18 months.
So that's an interesting point you mentioned, Manisha, that now it will be sort of skewed more in favor of corporates. But is that because of the kind of hits which global private equity funds, etc., have had in the public markets in overseas? Is that one of the reasons why they're also pulling back? And we keep hearing this in the startup ecosystem as well.
The dominant factor is the fact that the Indian balance sheets have cleaned up. Last 3-4 years, you didn't have that. You didn't have the large groups. You still had large groups saddled with debt, etc. You had banks who were constrained in lending. So today, large groups, whether it's through M&A or just CapEx, are looking to do more and more. And so I think it's more the corporate India coming back, which is a good thing, right? Every domestic market must have its own champions. So not only global champions, we must have Indian champions too, who are basically wanting to do more in India. So I think it's a positive outcome. And this is how it should always have been. I think the pendulum swung too much in favor of private equity. Not saying they're a bad owner. They've proven to be a very good owner of assets. But we must have our domestic options too. And that's, I think, what the market is demonstrating now.
And Manisha, you talked about, PE dominating the M&A scene. With valuation correcting, will we see more, control deals going forward?
Yes, I think you'll see more control deals, Anand. As I said before, you need a reset on the part of the seller who had seen very high valuations in 2021. So some sort of that reset needs to happen. But yeah, definitely, your comment is absolutely valid.
In the financial sector space, Manisha, we saw the big merger between HDFC Bank and HDFC. I mean, something which we've spent years in our career trying to speculate on, and now it's happened. And it's a huge one, which puts HDFC Bank in a very different scale altogether. Do you see more such consolidation happening in the financial sector, particularly?
Yeah, I think so. I mean, of this scale, I'm not sure, but I think you will definitely see more M&A, and you'll see more alignment of fintech with the traditional companies for two reasons. A, I think fintech needs deeper pockets of capital. I don't think all of them have the access to capital that they thought they had till last year. It's a business, as you know, anything in the financial services is a capital business, right? It's about being well capitalized. So you'll see more happening between the physical and the online space. You'll see more of that activity, and then you'll see large, well capitalized banks like other private sector banks, Kotak, Access. You saw did Citi's retail business. You'll see more of them look to acquire businesses. The NBFC space will see consolidation.
And apart from financial services sector, which are the other sectors where we will see some action? I mean, given the global turmoil, money becoming expensive.
Pharma, consumer is where you've seen most activity, and you'll continue to see that. IT services in India has demonstrated that it's an unparalleled sector, and today with tech becoming the most critical part in any business across any industry segments, integral part of their businesses. I think IT services will continue to do well. We can argue on the valuation and say maybe the valuation needs to be reset, etc. Especially given what's happening, to the global companies. So that space, pharma. We are the generics manufacturer of the world. We're a $60-70 billion industry today. We're the cheapest manufacturer of generics. So even of COVID vaccines, we showed how we can have large manufacturing abilities. So pharma will continue to be another sector that private equity likes, and consumer, because just it's urban middle class, rising affluence, rural incomes going up. The monsoon's good, so we expect rural incomes to hold up. So I think these are the sectors that private equity will like, and you'll continue to see more activity. And of course, let's not forget the tech sector, because of the kind of capital that a lot of early stage companies got, which now cannot sustain their business models because their business model was not robust enough to be sustained in a downturn. You will see these companies either consolidate with the larger companies. When I say larger companies, I mean larger companies in the tech space, or maybe offline larger players like the Reliance, Tata's, Birlas, etc. You saw the Tata Big Basket deal, etc. happen. So more of those kind of opportunities. The tech sector will see a lot of consolidation.
How much in some of these sectors do you think, Manisha, is consolidation going to be led by domestic stress? For instance, you've seen the PVR Inox deal happening. And both sides admitted that there was no other way, because the market was so tough that they had to come together. Do you see some of this being driven by domestic stress as well, apart from the opportunity part of it?
So Sourav, I want more than stress. I would say disruption, right? What's happening in your and my lifetime and careers? We've not seen the kind of disruption to business models like the kind that are happening today. As you said, you quoted the PVR deal. The OTT platforms are disrupting their business models so much that there is going to be a smaller market, and that smaller market, how do you survive? You survive if you get scale. So I think more than anything else, the disruption that technology is creating in every sector, and the larger players, very well capitalized players coming in every sector and basically being able to do a burn that other companies can't do, will force companies to start thinking about consolidation, because I think if you have economies of scale, only then you'll be able to survive in a large market like India. So some of it is, yes, I wouldn't say distress, but I would say disruption. The other is just, to be in a market as big as India, you want to have scale, because it's going to be a $5 trillion economy. And if you're a marginal player, then you're not going to have access to capital. Banks are not going to really be, supporting your large expansion plans, etc. So better to be aligned with a larger player and get access to capital.
Manisha sort of talked about the financial services sector, and we have seen even the government is planning to sell stake in or privatize a couple of banks and insurance companies. Do you see some interest there from the private side?
Definitely, I expect a lot of interest in state-owned banks. Look at the network they have, right, Anand? I don't think any private sector has invested in that kind of a network, especially now when Bharat not just India, but Bharat is getting affluent, right? The government's capital spend, etc., is all going into states and into rural India, right? So you cannot ignore that class of people who are out there, have aspirations, are going to be buyers of products and services.
Overall, I just wanted to figure out, what is your sense on the whole disinvestment play? I mean, do you think now that this government we've done Air India, we've done a couple of other big deals, some more like banks we just discussed are probably in the pipeline. Now, what do you think about the kind of activity which can be spurred by disinvestment?
So again, because domestic private sector balance sheets are looking stronger now, I feel more positive on privatization. Happy that corporate India is back to its buying spree, because you do need Indian corporates to come in and bid for these. Otherwise, I think just foreign capital is not going to be able to acquire these companies, just because they're going to feel limited in how to manage these companies. Foreign capital may partner with domestic capital, right? Mm-hmm. The sovereign wealth funds, the pension funds could easily back a large corporate, mid-sized corporate to go and buy some of these investments. But I don't think in an environment as choppy as today and as turbulent as it is today, people will want to make large bets by themselves.
Do you see a good pipeline coming from the distressed asset side? And second, even the interest of global distressed funds, we haven't seen much interest there, from the global side. I just need your...
No, I think you have seen interest, Anand. The oak trees, etc., of the world, Apollos of the world are around these assets and opportunities. So maybe they haven't written very large checks, but they have been testing the water and dipping their feet in it. That's typically how they start. A lot of these distressed funds have actually felt more comfortable just buying portfolios rather than buying companies.
Right.
FCs, financial services companies. A lot of the portfolios today, if you speak to any of the companies, financial services companies which went through distress, and you ask them, where's your portfolio? They say, we sold it to one of these distressed funds. So you're seeing the reason you don't see it is because, Anand, you don't see a headline deal that, this distressed fund went and bought this company. They have felt more comfortable just buying portfolios, and that's initially how every fund starts in any country. So you're seeing that. I think to your first question, the larger deals through the NCLT process are more or less done, right? But the small mid-sized ones you'll continue to see. Will that dominate the activity for the next few years? I don't think so, like it did in the last 5 years, because the big ones are done, right? But I think it's a trend that's here to stay, and I hope the banks, etc., continue to push keep the momentum going, because you don't want to lose momentum on something like this.
You've spoken a lot, very eloquently about the fact that Indian companies need to get into the M&A space now, and that's happening. And that's a good outcome, like you said. We've seen, however, that there are big names which are looking and scouting around abroad. Like we've talked, there is talk about Boots. There have been some acquisitions overseas, otherwise also from some of these big groups. And yet, when we speak to Indian big companies like Tata Steel, for instance, they are now completely focused on India. Now they've done 3 big acquisitions in India and spending about 51,000 crore in all. And now their whole focus is on the Indian market. So how do you see this inbound versus outbound playing out?
2022, we are such a large market now that Indian corporates are saying, look, why don't I invest my capital in a market and a geography which I understand well? I understand regulation, I understand the consumer, I understand the supply scape, and there is so much volatility globally. So do I really want to go and spend my dollars overseas in an unknown environment where access to capital is also now limited? If you're an Indian company looking to acquire a company globally, you're not going to get the kind of financing that, let's say, a global company would get, right? So in that environment, they're saying, let me spend my dollars in India. The market's growing. Where else are you getting 7 to 8% growth rate? I mean, we're all beating ourselves up about, is it 6.5 or 7.5? I mean, compare that to Europe, where there's negative to 0 growth rate, right? Look at what's happening in Japan, etc. So I think today, they are not going to go, corporates are not going to go and acquire companies for market. However, on your question on outbound, where I see outbound happening is where people want to go and acquire a particular technology. Let's say an IT services company, they have to service their customers. They want to acquire some cloud AI company, SaaS company. You're seeing that happening. You're seeing Wipro, Infy, all of them go and do those kind of acquisitions. Pharma may go and acquire that because pharma is so linked to the US and UK. They may in fact go and acquire because they want access to those markets, or the FDA regulations, etc. Or the front end in the US may understand better. So for very different reasons now outbound will happen as opposed to 10 years ago, because the Indian market is big enough. I don't need to go for the market. I go for very technical reasons, niche product that I need into my portfolio. That kind of acquisitions will happen. Inbound, I think, will continue, dominated by private equity, but strategics are also looking at India. Strategics are more active in India and the conversations around the green energy, renewable space, EV space. That's something that India has seen as a big market, and that's where dollar flows will come.
One question on this irrational, exuberance which we saw in the decade of 2000 in the outbound, case. Inbound, if I say, do you see any traces of, irrational exuberance? I mean, a lot of money is available.
Anand, I wouldn't say it was irrational exuberance, right? If you see, all the M&A has turned out to be good for the companies, right? If you look at a Tata Motors, Jaguar, or a Bharti Zen.
But they also did a lot of write-offs, so goodwill. Tata Steel.
Yeah, sure. I mean, any M&A has that risk, that domestic or global. But I'm saying it wasn't like they went and competed in these auctions and bid things very expensively, etc., etc. So I think some of the, for example, look at the Hindalco Novelis. Novelis is an integral part of Hindalco and contributing to 30-40% of their top line. But to your point on inbound, I don't, given what's happening in the global economy, I think of it as huge disruption and volatility, but there are people out there who say it could even be a recession. I don't see irrational exuberance in inbound companies that you may have seen in the last decade, triggered exactly as you said by excess liquidity, with the Fed printing money and everyone printing money, and just there was so much access to cheap capital. I think that game is over.
But you do believe that in domestic acquisitions also, the valuation froth is now going to settle for the next 12 to 18 months for sure.
Yeah, I think so. It's already correcting, right? See, India always is a high PE market because growth is high. When you adjust for growth, the multiples don't look that expensive. Right. So I think we are anyway expensive market, but to Anand's point, are they going to be like frothy deals and people just bidding and outbidding each other? I think that environment we're not existing in today.
So Manisha, it's there's been a lot of activity indeed. You've been a very, very busy person, we know, and doing these deals. But outside of work, outside of the deals, buzz, how do you relax? How do you wind down? And investment banking is a very high intensity kind of profession. We know that.
Yeah, and so I think, the last 2-3 years have been extremely hard on each one of us as professionals, just because this online world has just made us switched on 24/7, right? So whether it's a Sunday afternoon or a Monday night, you just switched on for your clients and for your colleagues all the time. So it's, I think, not just for me, for everyone, it's been very hard. Having said that, I think in terms of unwinding, I try and spend, different from what all of us do, try and spend time with my family. I play golf. I'm an avid golfer, rain permitting. Of course, nowadays there's no golf. I do some yoga. And the other thing that I'm passionate about, which I'm spending a lot more time in the last few years, is just mentoring young girls. And I've set up a school for the girl child. So that's really where my heart is in the next decade, to try and do as much as I can in terms of A, getting more girls to be educated, and B, getting more women to be retained in the workforce. So to whatever extent I can share my experiences, etc. I spend a lot of my time doing that with young girls so that I can help in some ways to retain women talent, not just at Moelis, but just across India, wherever I can.
Yes, you do a lot of that, I know, yes. Thank you very much, Manisha. It's been an absolutely wonderful discussion. We could go on and on till the cows come home talking about deals. But thank you very much for sparing your time and speaking to Business Today.
Thank you, Sourav. Thank you, Anand. It was a pleasure to speak to both of you.